To discuss the risk settlement options available to pension schemes, I'm joined now by Charles Ward. He is a professional trustee at Dalriada Trustees. Charles, thank you for joining us. What options are available to schemes?
Well, there's a range of options available varying by scheme size and funding level. The most straightforward is a full scheme buyout, where all of the scheme's assets, along with a top-up premium if needed, are used to secure an annuity for each member of the scheme. Typically, the pension scheme is then wound up after the annuity has been secured. Beyond this, there are further options for securing only part of the pension scheme's liability, which include, for instance, securing liabilities associated with current retirees, most commonly done in recent years. Typically, in that situation, the annuities remain an asset of the scheme until such point as it's wound up in the future. Another common approach is to enter into a longevity swap to protect the scheme against future changes in life expectancy. In this case, the scheme typically retains all of its investment risks, but passes on risks associated with longevity. We've also seen a fair degree of innovation in this space in recent years, where insurers can provide bespoke solutions depending on the precise risks that schemes are seeking to pass on.
Why would a scheme enter into a risk transaction?
Basically, this is all about managing risk. By securing an annuity, the trustees are buying full protection for a wide range of risks, which include, for instance, investment risk. Even the most sophisticated investment strategy can't provide 100% coverage against all liability risks. It covers longevity risk, which is quite difficult for schemes to insure in isolation, particularly for smaller schemes. It covers data risk, so where the scheme's data quality is reasonable, insurers will often take on cover for those risks. If the insurer won't provide that cover, it is possible in some cases to provide top-up insurance to cover against those data risks. One particular risk that's underappreciated in my view is legislative risk. So going through a buyout, securing the liability takes you outside the occupational pensions arena into the insured arena, and you're no longer exposed to future changes in legislation. A well-structured scheme buyout can cover against all of these risks.
But isn't this a very expensive thing to do?
Relative to typical funding approaches, it can be seen as expensive, with premiums often being 20 to 40% higher than the liabilities measured on the funding basis. However, many schemes are moving into a phase where they're fully funded against a low-risk measure of the liabilities, or a self-sufficiency measure, as it's often known. In these cases, the cost of insurance, particularly for current retirees, pensioner members, can be quite attractive. There's very little gap between the liability that's being funded and the cost of securing annuities. Having said that, the cost of insurance for deferred members can be seen as expensive. Typically, this is because those liabilities go out a long way into the future, and therefore very difficult to insure because of the uncertainty around future cash flows associated with those members. What we'll see, I think, over time is the relative cost of insurance coming closer to scheme funding measures, because more and more of the liability will relate to pensioner members, which are generally more affordable than deferred members.
What impact is coronavirus having on this market?
I'd say sadly for most schemes, the fall in asset values means that the premium to insurance has gone up, combined with difficulties employers are facing, and therefore inability to provide top-up funding. Schemes are less able to execute these transactions. However, there are some schemes which, prior to the crisis, put in place a high degree of interest rate protection, and which have a low exposure to more volatile assets. And in those cases, bulk annuities are now likely to be more affordable. Now, the reason for that being that annuity pricing is, at least in part, linked to the value of corporate bonds, which have fallen in value by more than the value of government gilts, and therefore the gap between a funding measure and a buyout measure has come down for those schemes. One note of caution I would sound is that any kind of investment activity in the current market needs to be very carefully planned, given the volatility that we're seeing, and therefore trustees need to ensure that they avoid any unintended losses through that investment process.
What should trustees do if they're interested in looking at their options when it comes to risk settlements?
First questions to consider are where are you on funding, and can the employer provide any top-up funding if you're not quite fully funded enough to get to a buyout, and the scheme actuary would typically be able to give a view on that. If the scheme is in a good position, then the trustees need to put themselves in the shoes of the insurer. Three key issues are data. investment strategy and legal certainty around the benefits. So taking each in turn. On data, the insurer will want to be sure that the data is complete and as accurate as possible. And this goes beyond the data that a scheme would use to run a day-to-day. So for instance, many schemes don't hold details of the pension due to a spouse following the death of a member. However, the insurer will want to know those figures in advance because that's a key part of their pricing basis. On investment, if a scheme is still pursuing a relatively risky strategy, that introduces volatility into the scheme's assets relative to the buyout cost, and insurers will be nervous because that reduces the likelihood of the transaction completing, and therefore they'd be looking for a strategy that is more closely aligned to the buyout cost. And finally, on legal certainty, the key is to ensure that the scheme's benefits are fully specified and that that specification is legally reviewed so that the insurer has 100% certainty over what it's pricing, and it captures any complications in the scheme's benefit structure. Importantly, a key element of that at the moment will be the treatment of GMP equalisation. If a scheme can tick all of these boxes, they're in a position to approach the market, and in that situation, I would advise any trustees to seek advice from a specialist in this area to make sure that they have the best chance of executing a successful transaction.
Charles Ward, thank you for joining us.
Thank you.